Hello friends. In our previous video, we discussed in detail about the various investment options that are available for us under Section 80C. We discussed about the eligibility criteria, conditions, returns and various other aspects. We also saw that Employee Provident Fund fetches one of the higher interest rates and it is one of the most tax-friendly options available to us. So in today's video, we will discuss in detail about the Employee Provident Fund and various other technicalities associated with it. Not only that, EPF has a special feature that will let you save more than 1.5 lakhs that is prescribed under Section 80C. To understand what's so special about EPF, watch the video completely till the end. Welcome back to our channel Intelligent Indian. If you have not subscribed to our channel, please consider subscribing to it. Before we get started, there is a brief disclaimer. We are not tax experts. This is not a tax advice video. This is only for education purposes. Please consult your chartered accountant or do your own research. Now, coming to Employee Provident Fund, the EPF Act of 1952 makes EPF mandatory in certain conditions. Number 1, if an employer has more than 20 employees. Number 2, if an employee's basic plus dearness allowance is less than or equal to 15,000 per month. Now the question is, what will happen to employees whose basic plus DA is more than 15,000? These employees can avail EPF with the help of the employer and with the approval of the Commissioner of the Employee Provident Fund organization. Now, Employee Provident Fund has three different aspects. The first one is the investment corpus, which is called the EPF, the Employee Provident Fund. The second one is the pension part of it, which is the Employee Pension Scheme. The third one is the insurance part, which is the Employee Deposit Linked Insurance. Now let us understand how EPF works. Let us say you are an employee in an employer who is registered under EPF Act. If you are availing EPF, what will happen is you will contribute 12% of your basic plus DA and the employer will contribute 12% of basic plus DA. What you contribute is called the employee contribution and what the employer contributes is called the employer contribution. This total amount is divided in the following way. Number 1, the complete 12% of the employee contribution is allocated to the investment corpus or the EPF. In addition, this employer contribution is divided into two parts. 3.67% of this 12% from employer contribution also is added to the investment corpus, which is the Employee Provident Fund, where you earn interest. The remaining 8.33% of this employer contribution is dedicated to the employee pension scheme. So as you can see, of this total 24%, 12% plus 12%, 15.6% goes to the Employee Provident Fund and the remaining 8.33% goes to the employee pension scheme. Now there will be a question to you. Most of the viewers would be working in the private organizations and their question is, I don't have a DA. What will happen to me? How do I calculate? If you do not have a dearness allowance or DA, you'll just have to use your basic in your total salary structure for computation of PF purposes. Now, there are some technicalities associated with the computation of EPF based on various conditions. If you are a mandatory or an eligible employee whose basic plus DA is equal to less than or equal to 15,000, you will follow this methodology. In this example, we have taken that the concerned employee's basic plus DA is 10,000. So 12% each will contribute 1200 each. So employer contribution will be 1200 and employee contribution will be 1200. Now, this 12% gets allocated directly to the Employee Provident Fund and 3.67% from the employer contribution gets allocated to the Employee Provident Fund. Now the remaining 8.33%, as we already saw, gets allocated to the employee pension scheme. So as you can see, this 1200 plus 367 rupees, 1567 rupees totally gets allocated to the investment corpus or the EPF, and the remaining 833 rupees gets contributed to the employee pension scheme. Now, what if your salary is more than or your basic is more than 15,000? There are following options. It depends on what policy your employer is following, right? So option 1, even though your basic plus DA is more than 15,000, let's say 50,000, the employer is not mandated to provide 12% of actual basic plus DA. They can limit their contribution and your contribution to a maximum of rupees 15,000. The second option is the employer and employee both can contribute to 12% of the actual basic plus DA. Now let us discuss these two examples in detail. Now, the first condition, what if the employer caps the contribution based on the basic of 15,000 rupees? Let us say in this example there is an employee whose basic plus DA is 50,000, but since the employee caps according to his policy caps the total contribution based on a basic of 15,000 rupees. The employee and employer contribution will be calculated on this 15,000, and hence as you can see 12% of 15,000 is 1800 rupees. So the employee contribution is 1800 rupees and the employer contribution will also be 1800 rupees. Now coming to the split up of employer contribution, as you already saw, 3.67% from the employer contribution gets into EPF and the remaining 8.33% goes to the employee pension scheme. So net as you can see, 1800 plus 550 rupees, which is 2350, goes to the investment corpus Employee Provident Fund, and the remaining 8.33%, which is 1250, goes to the employee pension scheme. As you can clearly see, the entire computation is made based on 15,000 rupees, even though the employee's basic plus DA is 50,000. Now let's come to the second option where it is actually computed on the actual basic plus DA. Let's say in the same example, the same employee has a basic plus DA of 50,000 rupees and it is computed on 12% of actuals. Now if you contribute 12% of employee and employer contribution, now as it is on 50,000, you can see that the employee contribution alone is 6,000 and the employer contribution will also be 6,000. As we already saw, this 6,000 directly goes to the Employee Provident Fund, and the 3.67% of this 12% of this employer contribution directly goes to Employee Provident Fund. Now the remaining 8.33%, which is 4165 rupees, 8.33% of 50,000, how does it get allocated? As we saw earlier, it doesn't get directly into employee pension scheme. What happens is only 8.33% of 15,000 rupees gets allocated to employee pension scheme. So which is 1250 rupees gets allocated to employee pension scheme, and the remaining amount 2,915 actually goes to the Employee Provident Fund. So as you can see, even though the computation is based on the actuals, right, the employee pension scheme contribution is capped at rupees 15,000 and the entire remaining amount goes to the Employee Provident Fund. Why is this relevant and why is this important? As your salary gets higher and if your employer contributes based on actual basic plus DA, right, it will be beneficial for you because Employee Provident Fund is the investment corpus and you earn interest on it, and employee pension scheme doesn't earn interest. So people with higher salaries, please watch out. If your employer contributes based on the actuals, this system is going to be beneficial for you. Now in addition to this, the employer also contributes 0.5% to the employee deposit linked insurance schemes. There are no returns on it. It is just a pure life insurance like a term insurance, and it just provides security for your family. Now let us look at the risk and the returns. Employee Provident Fund, as we already saw, it has three parts, right? The investment corpus, it earns interest on a year-on-year basis, and as we already saw, the employee pension scheme doesn't give you any interest and it is kept in the corpus and it is paid out as pension towards the end. The employee deposit linked insurance scheme, as we saw, doesn't earn any interest and it is purely an insurance product. Now as we saw previously in our previous video, the risk is a low risk instrument because it guarantees some amount of returns, unlike other instruments that are market linked. Currently it fetches a interest rate of 8.5%, but please note that it is not on the pension component and it is only on the EPF component. If you look at the history of the returns of EPF, in the early 1950s, 60s, it is very low, and in the 90s it touched a high of 12% and it is currently hovering around 8.5% and 8.6%. Considering today's FD rate, Employee Provident Fund is a very good option to invest. Now how does this interest rate gets decided? So the interest rate is decided on a yearly basis by the Central Board of Trustees of the EPFO organization, and it is approved by the Ministry of Finance. How does EPFO earns returns, right? Unless they earn returns, they will not be able to pay interest. They invest the money primarily in debt funds. 85% of the corpus is invested in debt funds and 15% is invested in the stock market, not in direct shares, through ETFs such as Nifty 50 and Bharat ETF, etc. And this is how interest is earned. As you can see, the returns from the debt instruments are between 5 to 7% on an average. There is a possibility that the interest rate of EPF can get reduced. Now, how are the interest calculations computed? Unlike many other investments, you don't invest in bulk in EPF. There is a monthly contribution by you and by the employer, and the interest calculations are based on monthly running basis. Let's understand this with an example which we discussed previously, where the employee and employer contribution contributes to 2350 that goes into EPF. Now, as you can see, let us say in the first month the employee contributes, the total contribution is 2350, and that is the first month. The employee doesn't earn any interest on it. In the second month, a similar 2350 is contributed. So at that point in time, how the interest is computed is these two contributions are added, which comes to 4700 rupees, and this 8.5% is broken for the month. So 8.5% is divided by 12, which comes to 0.70833 percentage, and this amount is multiplied by the monthly interest rates, and as you can see, the interest fetched is 33 rupees. This is added to the cumulative total. Similarly, every month this interest is computed and it is paid only at the end. Please note that even though this interest is captured on a monthly basis, the interest is paid only at the end of the financial year, which is on 31st of March. Now, let's understand the withdrawal process. You can completely withdraw EPF upon retirement at 58 years of age, or if you are unemployed continuously for 2 months, or in other cases such as premature death of the member, the nominee can actually withdraw the EPF amount. Partial withdrawal is allowed in certain cases such as buying house or land, loan repayment, medical treatment, or a wedding, and for each of these the conditions are very complex and different. As you can see here, for buying a building, you need to be associated with EPF for at least 5 years, and it is minimum of 36% of basic wages plus DA or the actual employee and employer share. So as you can see, the conditions vary for in each of these aspects. Now let us understand the most important part, which is the taxation. We early saw that the employee contribution will allow you a total deduction of up to 1.5 lakhs under section 80C, right? It comes under exempt. That is, your investment is exempt, your interest earned is exempt, and also the final maturity amount is also exempt. But there is one point to note. In budget 2021, the government proposed that if the employee contribution is more than 2.5 lakhs, then the interest earned is taxable. We did a quick calculation. If your employee contribution is 2.5 lakhs, then your basic per year should be around 20 lakh 83,000, which means per month your basic is 1 lakh 73,000. So only people above such basic amount needs to be worried about it. Since majority of the individuals will be below this range, you need not worry about this new rule. Now, let us understand why EPF is special. As we already saw during the beginning of the video, EPF allows you a higher tax benefit over and above the 1.5 lakhs provided under section 80C. As you might have noticed, EPF has two components, right? The one is the employee contribution, the other one is the employer contribution. Employer contribution doesn't have a limit of 1.5 lakhs and it is tax free. So if you are contributing employee and employer contribution, only your employee contribution is considered under 80C, their employer contribution is completely tax free. This is very beneficial for people in private sector and especially people with very high salaries. Why? Let's understand that with an example. As you know, the private sector pays salary in CTC format. They don't have a gross salary and separate employer contribution like PSU or government entities. Let us say an individual earns a CTC of 20 lakhs per year, and as you can see, he comes under a 30% tax bracket. Let's assume that the basic is 10 lakh and HRA is 5 lakh, and rest of the allowances and employer contribution, everything falls under the remaining 5 lakhs. What happens is, an employee contribution for the year will be 10% of the basic, which is 1.2 lakhs, and employer contribution again will be 1.2 lakhs, which is 12% of 10 lakh. So now the total deduction for income tax will be 2.4 lakhs. Only this 1.2 lakhs under employee contribution will be considered under section 80C, and this is not, and it is completely tax free. So an individual can get a net deduction from the total taxable salary of rupees 2.4 lakhs. Not only that, over and above this 1.2 lakhs, there is an additional 30,000 that an individual can save, because 80C allows for 1.5 lakhs deduction. So this is what is very special about EPF. The employer contribution is tax free up to a very higher limit. What is that limit? The limit is basically you have up to 7.5 lakh of employer contribution combined of EPF, NPS and superannuation fund. Till then it is not taxed, and beyond that it is taxed. So in this example, as you can see, the individual can save more than 1.2 lakhs, right? And hence he can save a tax of 36,000 rupees since he comes under 30% tax bracket. And in addition to that, he earns a higher interest rate of 8.5% on this 1.2 lakhs. So this is why EPF is special and it is better compared to many other instruments. There are some conditions. Interest will not be paid in certain aspects when the account becomes inoperative. What are those conditions? It is if the retirement happens after 55 years, or the individual migrates permanently, or there has been an unfortunate death of the individual and claim has not made for 36 months after the date after it becomes payable, right? Okay, so we understood so much of technicalities and details about EPF. So what do we do? Is it a good instrument or a bad instrument? Definitely EPF is a very good instrument. It fetches very good interest rates. There is an additional tax saving because of the employer contribution, which is over and above the 1.5 lakhs prescribed under section 80C. It comes under exempt categories, which is one of the most tax friendly options available to us. And most importantly, we can save this on a regular basis, and it doesn't come into our disposable income because it gets deducted directly by your employer. So using EPF is definitely beneficial for the individuals. But you need to watch out for the following. The interest rates keep changing every year, and because the debt funds returns are diminishing, you need to watch out for interest rates every year. Next, your employer contribution type needs to be understood. Every time you switch your employer, you need to understand what is a contribution made by your employer. Even in my family, there are some individuals whose employer contribution and employee contribution is capped at 15,000, and there are other family members whose employer and employee contribution is capped based on the actuals. So you need to understand what is your employer's policy in EPF. And as we discussed earlier, every year the budget brings new rules, so you need to be watchful of what are the terms, conditions, taxabilities, etc. Hope you like this video. To spread more awareness about investment, section 80C and tax saving, please share this video with your friends. Please give us a thumbs up and please do subscribe to our channel. Thanks for watching.